Hey everyone, my name's Andy. The channel's Finding Value. This is part two of the oil energy shock. We're going to jump right into it. I'll continue out kind of based off. There's a part one. It'll be in the description below. But let's dive in here, and I'll start off where we left off. We were talking about oil inventories being drawn down and prices having to go over $100 a barrel at least, at a minimum. And we're probably still going to draw down quite a bit. So let's keep going. We'll jump in here on the right-hand side. Deep water offshore is the modern frontier for new oil discoveries and supply. However, major offshore oil projects haven't been sanctioned since prices were sustained above $100 per barrel since 2010 and 2014. It takes at least 5 years to develop a major oil project with no major projects set to bring on new supply. The oil market has at least 5 years before significant supply growth outside of OPEC and the U.S. is forthcoming. Meanwhile, OPEC Plus supply constraints are likely to emerge as soon as this coming April. By that time, OPEC Plus quotas will exceed the IEA's estimate of the group's maximum production capacity. If by then the group is still woefully short of its quota, concerns are likely to arise that it's incapable of increasing production to pre-pandemic levels. So, we've got a lot of shortfalls coming from OPEC. And I don't think they've got the oil to pump. With the U.S. and OPEC facing supply challenges while demand continues to rise, the world is speeding toward an oil supply crisis. In the past, oil prices have tended to surge to higher levels when anticipated demand growth 1 year ahead of exceeds estimated spare capacity on a 1 year ahead basis. That point is likely to arrive in the second half of 2022. Unfortunately, if the ongoing energy supply crunch in Europe is any indication, the public is only likely to learn about the dire oil supply outlook after supply has already run short. So this is some crazy stuff here, guys. China, India, and Southeast Asia oil consumption, 65 to 2019. This thing is rolling higher, guys. Thousands of barrels a day. We are going to be rolling into, and it's increasing for everywhere. China's total oil consumption per capita was where India is today. At present, India's population is 6% larger than China's was back then, and these things we're ramping up of oil use worldwide. And I'll show you in the next one what the global oil consumption is. Just to touch on a little bit of this, of the 100 million barrels of oil consumed throughout the world each day, 61 million barrels is used in transportation. Of that, 61 million barrels per day, 24 million barrels per day is used by light-duty cars, 22 million barrels per day by trucks, 8 million by planes, 7 million by ships, and public transit. Efforts to reduce oil consumption take aim at the 24 million barrels per day used by light-duty ICE cars. The EAI estimates that there are 1.31 billion ICE cars and 9 million EVs, including hybrids. The EAI forecast that EVs will grow to 672 million by 2050. However, the agency also forecasts that over the same time frame, the global ICE fleet will nearly double to 2.2 billion. This is what I don't think people understand. The internal combustion engine car fleet will nearly double to 2.2 billion from 1.3. EVs are just offsetting the growth. They're not offsetting ICE cars. Such a scenario would see gasoline demand grow, even assuming increased fuel efficiency. Looking at it says on here, in the U.S., the EIA doesn't expect ICE car sales to peak until 2038, 3 years later than Biden's administration target to convert 50% of the U.S. vehicle fleet to EVs. Global oil consumption by product, 1980 to 2019. Doesn't look like this is slowing down, guys. This thing is moving on up. Low-hanging fruit in reducing oil consumption, well, it's continuing to move because we are, as a world, we are increasing our energy use per capita quite dramatically in the third world countries as they develop their countries. This is going to accelerate and remain elevated. I don't think it's going to slow down. Looking at this, just to touch on demographics will drive growth. We're going to 7.7 billion and will grow by 2 billion by 2050 in terms of population growth. Sufficient to increase oil demand by at least 1% a year. Developed nations' total population forecast to grow by 50% by 2050. And they're trying to go after the Western lifestyle, which means The following table shows the per capita oil consumption for each country. Notice the gap that exists between US and its population of 331 million and the developing nations. With their combined population of 44.9 billion, nearly 15 times that of the US. I think I already went over this in terms of per capita consumption. The greatest challenge for EV targets in wealthier nations is the additional electric power generation and transmission capacity that will be required to power a fleet of EVs. Most regions have to increase their existing capacity by 50 to 100%. That's a huge barrier to entry, guys. The massive power grid buildouts begs the question of what will happen to prices to copper, lithium, nickel, and other commodities as their demand explodes higher. What will happen to the price of natural gas as increasing quantities are conscripted for electric power generation? Will surging commodity prices impact the cost of EV rollout and the rate of EV adoption? Yes, it will, in my opinion. These are but a few of the factors that must be taken into account before society launches open, potentially ill-fated campaigns against in the trillions of dollars. Looking at the global energy and population, here's the population, but boom, straight higher. This is the energy growth with that population. If population increases, and we're supposed to expect 2 billion more, the energy will grow massively, and I don't think that we can generate it with renewables. So we're going to just continue to pile into fossil fuels, the demand, and the supply, I don't know if it will be there. This is going to be a massive energy crunch, guys. It's going to be ridiculous. For energy investors, for the 2014 to 2020 bear market has been incredibly brutal. But as the old adage goes, low commodity prices cure low commodity prices. Our deep understanding of U.S. shale and other oil market fundamentals lead us to believe that we are finally entering a multi-year bull market. Investors should take advantage of the incoming trend and be positioned in real assets like precious metals and energy stocks. God, this guy's good. I love it, what he says there. I totally agree with it. It says, we're going to go over here to the right. It says, oil producer share prices are underperforming oil prices and the broader market. The 2-year WTI strip price implied by historical regressions of XLE to S&P 500 versus WTI and actual 2-year strip price dollars per barrel. Looking at this, the oil price has rocketed higher, and the 2-year strip price of XLE to S&P 500 ratio is drastically falling behind, which means that XLE, the companies and the shares, are far underpriced. We know this on the channel. We invest in oil heavily because of this. We are exploiting this huge energy crisis problem. Oil's taken off and the energy companies have not kept pace. I know we've gotten great returns in oil companies, but guess what? There's a whole bunch left in it. This tank is 3/4 full, not half full, 3/4, and it's filling. It's not empty. We are filling this bad boy up with value. And we have a lot to extract from these companies. It says once equity investors get a whiff of the looming oil supply shortage, the valuation gap will close swiftly. When oil prices rise in a supply-constrained market, oil stocks are the only place to hide. High oil prices will be a headwind for virtually every other stock market sector's performance due to the drag they exert on business results, but also from their knock-on effects to capital markets, such as stepped-up inflation and higher interest rates. God, I love this guy. Such a great comment there, and I agree with it. Like 1 billion%. The knock-on effects to capital markets, such as stepped-up inflation and higher interest rates, is that's exactly what's going to turn all of this money and rotate it into energy and other markets. In such an environment, investors will pile into energy sector to keep from underperforming. We saw such a scramble when oil prices soared in 2008. That's when they went vertical. We are far early in this game, everyone, for the energy crisis. They will go vertical. We will see oil prices go much, much, much higher. The last time prices were sustained above $100 a barrel in the 2010 to 2014 timeframe, the energy sector comprised 15% of the S&P 500. That figure today is a historically low 2.9%. We can see it in the ratios, and this guy is obviously looking at it at that gap and doing the math against the ratios. The gap between these figures hints at the outperformance that is possible once energy equities regain favor with investors. We're approaching the point where oil price fireworks begin, namely when the year-ahead demand outlook exceeds year-ahead supply capacity. This condition is likely to be met in the second half of 2022. Energy investors should take advantage of the recent price weakness in oil and oil equities to position their portfolios for the long-term bull market that lies ahead. So, this is obviously awesome. I completely agree with the article. This is another guy that has a similar viewpoint to myself. I don't think OPEC has the capacity, guys. I think they're flat out already. And I think that the valuation gap in oil is tremendously large. I'm going to do a part 3 to this. I'm going to go over all of the ratios, and I'm going to go over some of the companies and their charts, and they look ridiculous. They look ridiculous. This is a life-changing investment opportunity. If you've been on the channel for a while, you know that we're heavily in oil. I'm a huge oil bull. Huge oil bull. And I'm a huge energy bull in general with uranium as well. I do like precious metals as well. You notice that I took the stance that I'm in royalty companies. This is also going to impact gold and silver and other metals. They're going to try to ramp up the production of EVs. High prices cure high prices is what people say, but guess what? Not when you've got all these gaps. The gaps here are insane. And what I mean by gaps is we can't increase oil production very quickly because of the supply time frame it does to take this, to put them online. Then you've got gaps between EV vehicles, renewables, and those gaps are how fast can we produce copper? How fast can we grow that copper production? How fast can we grow nickel production? How fast can we grow all these different items? If you've noticed, I've always looked at it from the energy paradigm in my portfolio. I'm doing physical metals. Physical metals, when there's earth between you and physical metals and the price rockets higher, that means the cost curves are going to rocket higher. It means anything that is a high energy intensity. And I've gone over the energy intensity of copper production with declining ore grades and declining ore grades worldwide. We're about to hockey stick in our energy use up. What that means is that if you hit an energy crisis and your input costs are rocketing higher for the energy it takes to extract declining ore grades, you just figured out the puzzle. So what I've done is I'm taking the physical metals. I'm saying, give me the physical metals. Good luck trying to get this stuff out of the ground. If I'm going with assets, I'm going with royalty companies that don't have the input costs, the energy input costs. I'm loading into royalty companies. Why am I loading into royalty companies? If they can still produce, the cost curves will go up, squeezing margins. If this were to happen like this, squeezing margins, and the royalty companies don't get their margin squeezed. They just care about price and volume, and they get a percentage of price and volume. They're going to make more money if the prices go berserk. I think the prices will go berserk. Because if in an energy constrained world, if you've got metals between you, if you have earth between you and the metals that you're trying to extract, it takes energy to get that metal out. We're going after declining ore grades, increased energy input costs. This is perfect, guys. And if they can't ramp, you kind of have to think through this. If oil goes berserk for a 5, 6, 7, 8 year or longer time period, we're going to try to go to these other areas. Renewables, EVs, doesn't matter. We don't have the materials to do it. We just don't have the materials. Invest in those materials and try to do it in a way that protects yourself and shields yourself from higher energy input costs. That's, I would say, the best way to play this, in my opinion. Then, if we run into constraints for renewables, if we run into material constraints, what is the market going to do next? They're probably going to flick on nuclear power plants. That's my guess. Or they're going to build more nuclear power plants. So they're going to diversify their way of storing energy. Another thing is the hydrogen economy. Hydrogen economy is very well could be the next thing they hit. So the way that I think we should play this is directly with oil and natural gas. Obviously, a huge bull there. I think uranium is going to get hit hard. That's one of the spots that can get the huge squeezy, as I like to call it, just squeezing the heck out of it. And we got financial players ready to squeeze the living BALLS out of this. They're going to squeeze the balls out of this thing in terms of a financial squeeze. So you got to be, I think, positioned in uranium. Those two, oil, natural gas, and uranium, historically have been the largest performance gainers, the largest, most volatile and largest, best performing areas in commodity bull markets. I would definitely have exposure to those two areas: natural gas, oil, and I'm talking about exploration companies that can grow production, small little guys that are good. And we'll talk about what investments are in oil and natural gas in another part 3 or part 4. But this is coming. It's coming, and we've got a year or less to position for this. This pullback is a perfect time to be finalizing your portfolio. I'll talk about companies. If you go over my daily technical analysis in oil, I talk about all the companies and we're doing the charting. The charts look fantastic. It looks ridiculous. The setup is ridiculous, guys. You're lucky that you're on this channel and that you can participate in this, because I can show you exactly the chart patterns that humans are putting up here. You've got the data here. It's got the fundamentals behind it. The fundamentals are creating the technical chart patterns. The people are interacting. We're putting in massive head and shoulder bottoming patterns, big boy patterns. And I'm going to make comments to give you guys the edge over everyone else. So look for part 3. This is part 2. This is the fundamental part. The technical part comes next, and the ratios. Remember, I'm a 3-pillar guy. The 3-pillar guy is ratios, market conditions, and technical analysis. We have to hit all 3. If all 3 gives us a go, you go big. Now, I'm not saying that this is not financial advice. This is my opinion. But when you go big is when all 3 align. We have alignment of all 3. And I'll go over that in another part 3 clip. If you guys like this analysis, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.